Welcome to the Wespath market update for the third quarter. Roughly 90 goes, I started this section talking about the rapid recovery and how we moved to extreme optimism at the end of June. So if you remember, back by the 4th of July, many people were back in the office, there was no Delta spike in the US, and life was really getting back to normal. So perhaps I jinxed us, or I have really bad timing, because we quickly shifted away from optimism after the Delta spike in July. This has delayed many from returning back to work and delayed that normalness that we briefly touched on in June. There are other themes that have raised the level of uncertainty in the markets, such as China's Evergrande solvency issues, and is this symptomatic of a bigger issue with bad debt and leverage in China? There are delays and lack of clarity around the U.S. debt ceiling, also infrastructure and the next year's potentially $3.5 trillion budget. We have supply chain issues that will last longer than expected, unemployment shortages causing challenges all over the U.S., and then the resulting inflation that now looks set to last another maybe 12 to 18 months. Lastly, some of the support, or the outside support for the markets, both in terms of government spending and also from central banks, will likely start to be removed by the end of the year. So in 2021, we started the year in the midst of COVID and continuing to work from home, with vaccines in Q1 and Q2 setting the stage for a continued economic recovery. In Q3, the Delta variant has been the dominant theme. And with the other themes I mentioned, we've seen a negative impact on asset prices. So we closed the third quarter more bearish or pessimistic than we started. There are certainly more headwinds and unknowns for the fourth quarter. So let's look at a few data points on COVID, which we believe is one of the main drivers of the policy responses from the Fed and the government. Borrowing a chart from our friends at JP Morgan. Looking at the chart on the left, the blue line represents the 7-day moving average of confirmed COVID cases. This peaked at 260,000 in January, and this had fallen to 15,000 by the end of June, which drove the optimism that I mentioned earlier. So infection rates then spiked to 160,000 in early September, but then now have fallen to 85,000 by mid-October. So we appear to have peaked. The black line represents deaths, which also appears to have peaked. So the peak is at least in part driven by vaccines, with the U.S. at 65% of the population with at least one dose. Looking at the chart on the right, this is an estimate of three things: those who've gotten COVID and should have antibodies, those that are vaccinated, and those that have both been infected and have a vaccination. So this upward left to right upper chart is JP Morgan's estimate as to herd immunity, meaning those who should have some level of protection against COVID or at least a severe reaction. At over 80%, it is closer to what has historically been herd immunity and a positive sign for a return to normalcy. Let's look at monetary policy briefly. I started this session with COVID rates because for the past 18 months, the reaction to the virus, fiscal and monetary, has been the biggest market driver. In this case, this is the Federal Reserve Fed funds rates, which has fallen from 1.5% pre-COVID to zero. However, with the economy recovering and inflation moving higher, you can see the forecast for higher rates in 2022 and in subsequent years. Some of the support for the markets is therefore forecast to be less in the next few years. We've shown the Fed's balance sheet in the past. It's basically doubled in response to COVID and is still growing at $120 billion per month. I thought this graph helped show the makeup of that growth in the balance sheet. So looking at the dark blue, this represents mortgage-backed securities, which were being tapered or run off the balance sheet before going into COVID. In response to COVID, the Fed sharply increased its purchases of treasuries and mortgage-backed securities. But for mortgage-backs, it was more pronounced, as you can see here. This has been a major tailwind for the red-hot housing market. And I should add that we now believe that the balance sheet tapering will begin before the end of 2021 and into the end of 2022. Again, this is a level of support being removed from the markets. Let's look at market returns for the quarter and for the year, where we basically had strong numbers on a year-to-date basis, but as we will discuss in Q3, many returns were negative, and that largely happened in September, or the recent end of this quarter. The best performing index year-to-date has been the Wilshire REIT Index. What we don't show here is that for the month of September, this index was down 5%, erasing much of the July and August gains, and it's the worst performing index for the month of September. The REIT sector was hit in September as yields pushed higher which was driven by inflation fears. For U.S. stocks, let's look at them starting from large to small cap, which is also how they rank in terms of performance, with large cap outperforming small on the year, which, if you remember, small cap started off the year ahead of the other indexes. The S&P 500 has risen just under 16% through Q3 and was fairly flat on the quarter. But note that the index lost just under 5% in September, similar to the REITs index. It rose in July and August and then erased those gains in September. The September decline for the S&P 500 is the first since January, breaking an 8-month streak of positive returns. The MSCI SMID Cap Index is just behind the S&P 500 at 15.5% for the year, losing just over 1% in the third quarter. The Russell 2000 or Small Cap Index lost 4.3% on the quarter, and year to date, the returns are now 12.4%. So if you remember earlier in the year, small cap stocks were outperforming large cap. This was on the back of the reopening theme, as they're very pro-cyclical. As the Delta inflections rose and mitigation measures were put back in place, small cap names have been hit and are trailing large cap now for the year. Looking at international indexes, the MSCI ex-US index is up 6.8% on the year, losing 3% in the third quarter, all in September. Again, the international markets continue to lag the US, and there are a few reasons for this, but we also believe there are great opportunities in this sector. In emerging markets, it's a similar story, underperforming the US. And really the EM story is about China, which is roughly 40% of the EM index, and was down 18% on the quarter and 16% for the year. I want to take a few minutes and look at equity charts. We get a lot of questions on if the market is expensive. And it's expensive relative to historical measures, but I want to point out that asset classes can remain expensive for a long time and yet keep moving higher. Also, historically, we've never seen interest rates this low globally, which makes the comparisons more difficult. But in this chart, you can see that the price-to-earning ratio of the S&P 500 was 19.2 times pre-COVID. And at the end of the quarter, even with sharply higher index levels, the PE ratio is just 20.3 times. So why is that? Because even as prices rose for stocks, so did their earnings. And one could argue that the increase in earnings was a significant driver in the equity price move over the last 16 months. So looking at price earnings again here on the slide, looking relative to the last 25 years, currently at 20.3 earnings, we are at high levels historically, but less than the dot-com days. And also, as mentioned, low rates and limited opportunities in fixed income are a factor here. And also note that the PE ratio was higher in recent months and has come in lower with strong earnings of the past few quarters. Last quarter, we showed a chart that showed how the US or international indexes outperform each other for long periods. And currently, the US has outperformed for over 10 years. However, we wish to point out that the S&P 500 is currently more expensive than the MSCI International Index, with the US at 20.3 and the ACWI at 14.3 times earnings. This is a 2 standard deviation difference, and this supports our belief that there are opportunities to outperform in international equities in the next several years. Before we talk about fixed income, let's take a quick look at the US yield curve, as it helps explain the fixed income performance for the quarter and for the year. The top line in blue is January 2020, so pre-COVID, with a higher and a flatter yield curve. The bottom line in yellow is the start of this year, January 2021, so 9 months ago. The curve was flatter and lower than we are because we were still in the early stages of the reopening and getting the country vaccinated. The orange line is the end of September, or the end of the third quarter. So the rise from the beginning of the year until now helps explain why fixed income returns are somewhat low on the year, as rates have risen in 2021. Bond prices have fallen due to that inverse relationship. Let's look at fixed income on the following slide. The broad bond index, the Bloomberg aggregate, is down 1% on the year and was flat on the quarter. But look at the high yield index with just under 1% return on the quarter, but up 4.5% for the year. That is from spread compression. meaning the amount that investors are paid to hold high yield or risky bonds over risk-free treasuries. As investors have sought higher yields or took on more risk, that spread over treasuries has sharply narrowed, pushing high yield bonds higher, the best performer in fixed income. As the economy has recovered, the riskiest parts of the market have outperformed in the U.S. Now, the emerging markets aggregate is also riskier than treasuries, but has negative returns on the quarter and for the year. This is in part due to idiosyncratic factors in a few countries. So, for example, poor government in Brazil or the increased regulatory situation in China, for example. Low vaccination rates in emerging markets have also weighed, though they are making great strides there recently. Lastly, some of the emerging markets' weakness is really currency weakness, as the dollar has outperformed most of the emerging market currencies. Lastly, note the commodity index at the top of the chart. Dave and I will talk about this shortly, but there are several factors here at play, from supply shortages to huge increases in demand. Also, remember that energy is 30% of the index, and oil has doubled since last year, helping to drive those higher prices that we're all experiencing. That's all for the Q3 market recap.